Welcome to DebtCircle Key Roundups. I am Vijendra.
And I am Leela.
We've got some important updates in the world of corporate debt and finance. First up, Deccan Cement shareholders have approved the issuance of 103 crore rupees worth of compulsorily convertible debentures, while Nelco's shareholders have approved higher borrowing limits and a new non-convertible debenture issue. Credit Access Grameen has also allotted 100 crore rupees worth of NCDs through a private placement. Stay tuned as we dive deeper into these developments and explore what they mean for investors and the market.
Deccan Cement secured shareholder approval to raise 103 crore rupees via compulsorily convertible debentures at 715 rupees each. The proceeds will help repay a 330 crore rupees term loan from the State Bank of India by July 31, 2026. The move lowers financing costs by replacing an 8.5% loan with a 6% coupon CCD, reducing the interest burden and improving cash flow.
Post-issuance, new allottees will own 9.33% of the company, diluting the promoter's stake from 56.25% to 51% without changing control. Care Ratings Limited will monitor the use of funds. One shareholder approval of more than 99.9% reflects confidence in management's strategy to strengthen the capital structure and support future growth.
Meanwhile, Nelco Limited shareholders approved 4 key resolutions with over 99.90% support, including higher borrowing limits, issuance of non-convertible debentures through private placement, creation of charges on company assets, and related party transactions with Tata Capital Limited. The overwhelming support demonstrates investor confidence and reinforces Nelco's focus on growth, capital management, and financial stability.
Credit Access Grameen allotted 10,000 senior, secured, rated, listed non-convertible debentures totaling 100 crore rupees through a private placement maturing on June 12, 2028. The debentures carry a 9.15% coupon paid monthly and are linked to the State Bank of India's 3-month marginal cost of funds lending rate plus 90 basis points.
The listing on the wholesale debt market of BSE Limited adds liquidity, while investors benefit from a first-ranking charge on book debts and receivables maintaining at least 1.10 times coverage of principal and accrued interest. A 2% penal interest clause on defaults and pari passu redemption provisions further strengthen investor protection.
IBL Finance allotted 50 secured non-convertible debentures totaling 50 lakh rupees, each with a face value of 1 lakh rupees. These instruments carry a fixed coupon of 13% per annum payable monthly and mature on October 9, 2028. They are secured through hypothecation of receivables and maintain a minimum coverage ratio of 1.05 times the loan amount.
The structure offers attractive monthly income, although investors must consider the unrated nature of the debentures and applicable taxation. Delays in payment attract an additional penalty interest of at least 1% per annum above the coupon rate, adding another layer of creditor protection.
Noble Polymers Limited's extraordinary general meeting approved a substantial increase in authorized share capital and amendments to the Memorandum of Association. The company also passed special resolutions to enhance limits on loans, guarantees and investments, improving financial flexibility and widening its operational scope.
With oversight from a practicing company secretary and commitments toward timely disclosures, the restructuring aligns with regulatory standards while enhancing transparency and expanding future funding options through equity issuance and convertible warrants.
Ashoka Buildcon has voluntarily withdrawn its long-term and short-term debt ratings from CRISIL. The long-term rating previously stood at AA- with a negative outlook, while the short-term rating carried an A1+ designation. Although the withdrawal does not immediately affect credit quality, investors will now depend more heavily on assessments from other agencies.
The reasons behind the withdrawal have not been specified, but the development highlights the importance of continuous monitoring of alternative rating agencies. Investors should remain alert for any changes in outlook, downgrades, or transparency concerns that could affect the company's credit profile.
Aptus Pharma plans to raise up to 51 crore rupees for expansion through a mix of 35 crore rupees via preferential allotment, 10 crore rupees of debt, and 6 crore rupees through internal accruals. The proposal balances equity and debt financing while preserving financial flexibility.
The preferential allotment remains subject to shareholder approval, while final details such as pricing and allottee selection are still being finalized. The staged approval process supports regulatory compliance, transparency, and investor confidence throughout the fundraising exercise.
Over the last 10 years, silver delivered the strongest asset returns with gains of 21.3% per annum, outperforming gold at 18.5% and all major equity segments. Demand from electronics, renewable energy, solar power, and industrial applications has been a major driver.
Gold continues to serve as a stability anchor, delivering 11.7% returns in 2026 amid geopolitical uncertainty. At the same time, large-cap equities have declined 10.2% this year, reflecting caution driven by foreign outflows and broader economic concerns.
Vedanta Resources is buying back bonds worth $3.6 billion as part of a larger $5.4 billion refinancing plan. The company is expected to pay a premium of $250 to $300 million because existing bonds are trading above par.
The improved credit profile and stronger commodity markets have enabled Vedanta to refinance at yields of roughly 7%, compared with previous coupons ranging from 9 to 10%. The company is also targeting repayment or refinancing of an additional $1.8 billion in bank loans.
State Bank of India and Bank of Baroda plan to raise $1 billion through 5-year dollar bonds using the Reserve Bank of India's subsidized hedging facility. Each institution is expected to raise approximately $500 million while benefiting from a fixed hedging rate of 1.5% per annum.
The facility significantly reduces hedging costs and lowers overall borrowing expenses to roughly 6.25% to 6.50%. Analysts believe the initiative could attract up to $20 billion of overseas inflows while helping institutions diversify funding sources.
Immelt Finance has secured a 10 crore rupees term loan from ICICI Bank to expand its earned wage access program. The funding strengthens its lending capacity, broadens funding sources alongside State Bank of India, and supports future growth opportunities.
The company disclosed the facility to BSE Limited on June 13, 2026, demonstrating regulatory compliance and transparency. Despite recent stock volatility, Emerald Finance has delivered a 5-year return of 232.31%.
Hexaware Technologies has launched a new delivery center at Gujarat International Finance Tech City, or GIFT City, focused on banking, financial services, and insurance clients. Over the next 3 years, the company expects to create approximately 1,000 high-skilled jobs across software engineering, artificial intelligence, cloud computing, and digital transformation.
The Reserve Bank of India's expected credit loss norms, effective from April 1, 2027, will require banks to provision for potential defaults in advance. Borrowers with CIBIL scores below 730 may face tighter lending standards, while banks adopt more predictive credit risk models.
Samco Securities has launched a platform enabling Indian investors to buy US-listed stocks and ETFs, with investments starting from $1 through fractional ownership. The platform provides research coverage on more than 700 global securities, including S&P 500 and Nasdaq 100 companies, along with over 100 ETFs.
Indian government bonds rallied as crude oil prices declined sharply, while State Bank of India and Bank of Baroda prepared overseas bond issuances. Meanwhile, the Shapoorji Pallonji Group reduced its refinancing tranche from 25,500 crore rupees to 22,000 crore rupees and sought extensions on 14,300 crore rupees of maturing bonds. Rising hedging costs, covenant pressures linked to Tata Consultancy Services shares, and yields touching 21.75% highlight the challenges of refinancing high-cost debt in a volatile market, even as companies across sectors continue adapting their funding strategies and capital structures.